Hi folks, welcome. Another Tuesday evening, another live stream. Great to see you on. Thank you very much for taking time out. And we're going to have a very interesting conversation with Damien this evening. Of course, lots to talk about: Trump, tariffs, DeepSeek, and the Aussie dollar. to name just a few. So it will be quite interesting. And nice to see some new names as well as some of the old faithfuls. Hi, Smooth. Great to see you there. Cookie, Jason, Drew, Jump, and One Burjo, and quite a few others too. Excellent. Now, let me just give you a bit of a view. For those who have not seen the studio, this is it. Damien teed up, ready to come in over there. So he's all good to go. And of course, we have the normal system as always with the multi-view and the chat and various other things. I've got the Aussie dollar up here. We might put that up in a second. It's now at 62.04 cents against the US. So that's pretty low. And of course, we have the dogs. We have to show the dogs. And Luna was working on her dew claw in the pre-show, you may have noticed. She does that, always has done it from whenever we had her. And there's nothing wrong. It's just that from habit, when she's bored, that's what she does. Anyway, she's asleep now, so that's good. Hopefully they'll stay quiet over the show. Anyway, I think that's enough. We're on time, so I'm going to take the pre-show off. I'm going to run the start of show, and I'll be back in just a moment. Well, good evening and welcome to this live stream on the 4th of February, 2025. It's Martin North here from Digital Finance Analytics. Great to have you on the show this evening. Thank you very much for taking some time every Tuesday and sending it with us. Have Damien ready to come in just a second, and we're going to look at some of the market issues, management of portfolios, investing. How do you make sense of the current stupidity that's going on at the moment? Do you just look through it, look past it, or does it change your strategy in terms of investments? And all of those questions will come up tonight. And as always, of course, you're welcome to throw questions in. I will remind you that we don't provide specific financial or legal advice. This is a general conversation only. We moderate the chat, but feel free to throw your comments, questions, and suggestions in. I won't necessarily follow all of the threads there, but if you have a specific question for Damien or myself, if you use that Walk the World, that'll get into my queue and make sure that I see it and we can then discuss it. I've also enabled Super Chat, which means that you can get your question to the top of the list or indeed make a contribution to what we do around here. Those contributions are really greatly appreciated and help to cover the costs of what we do here. We do this not for profit, but because we think there's a really important conversation to be had. Now, let me bring Damien straight in and we can get going. Damien, welcome back. How are you?
Not too bad. Yourself, Martin?
Yeah, pretty good. I'll tell you what, we live in interesting times. Here we are, beginning in February, and already it feels like a whole year of stuff has happened.
Yeah, look, if we were having this conversation 2 days ago, it's very different to what we're having today. So, there's there's things are moving quickly. And so I think I want to sort of have some big picture sort of thoughts on that as well as to how you should be playing this from an overall point of view as well, because there's if you're trying to trade these markets, you're one tweet away from losing lots of money or making lots of money. It's I'm assuming it's all outside your control.
Yeah, and I sometimes think that if you're a trader, then you're going to be looking for all of the niches of volatility and running here, running hither, running there, running over there, wherever. But sometimes, if you are actually a longer term investor, the interesting question is to what extent you look through those things. To what extent do you just say, well, these are short term noise? But what is the signal? What is the signal underneath the noise that's telling me, is there something fundamental here that changes? And I guess DeepSeek could be one of those. Was that noise, or was it something important about the message of AI? Is the tariff situation, Trump exerting just power, or is there something actually changing in terms of the rules-based world order that is significant and could actually change the relative advantage of one economy versus another, or one industry versus another? And I guess a good example would be the automotive industry. If you look at what's happening there, you could say, well, there's something more than just noise there. There is a signal. So I guess that, as an investment analyst, the real question is, how do you tune your discriminators to separate signal from noise?
Yeah, absolutely. So I think for me, it's about having some broad-based sort of macroeconomic views about where we're sitting in terms of inflation and growth and other factors, and then how that's and then tuning that as things go along. So what we want to do is making sure that we've got the stocks we want, or sorry, not we may not actually own the stocks we want. We know which ones we like, and we know what we're looking for. And then as you see the noise and some of the stocks fall or rise, then you can start saying, okay, I'm actually going to start picking up some of those stocks because they're the ones now at a price that I think is reasonable for that longer term. There's definitely there's definitely different types of stocks though as well in terms of how you need to look at them, because some of them are very particularly some of the ones very much growth driven. You need to be worried about what's the latest, and that's very important, and where's it going to go, and you try and extrapolate out these short-term trends into forever. But for a lot of the big ones, it is really about saying, where do I think the long-term trend signal line is? Where do I think is good value for this stock, and trying to trade off with that. I think there's a lot of people who talk about Warren Buffett in particular as being a value investor, and that is to some extent true, but he's actually, I think for me, he's much more about a quality versus value, and I think that's where you need to keep coming back to with everything, is saying I need a different axis. It's not just about buying the cheapest possible stock. It's about trying to find the cheapest possible stock with this type of quality or this type of growth or whatever it is. And I think if you're trying to do that, that'll get you in some that'll help you a lot more than your investments than just trying to pick with one measure and trying to optimize on that. So you spoke about the car companies. Well, for the last couple of years, as long as you're not Tesla, you've been trading on 3-4 times price to earnings ratios. Every now and again you look at one and it's 6 or 7 times price to earnings ratio, and you go, "Wow, that's expensive relative to the rest of the peer." And meanwhile, the market's on 20-something times. And so, picking that one measure, if it's running into trouble, is not going to save you.
Yeah, and it seems to me, I don't know what you think, but there seems to be a slurping noise at the moment with more and more of, funds flowing into the US. The US seen as a distinctively bright spot in a relatively uncertain world. And you could argue perhaps that the Trump's approach to tariffs, apart from being just exerting power, which of course he's done with Mexico and Canada to an extent, is also trying to maintain that US exceptionalism. And if you look at the flow of investment dollars, they are still heading towards the US rather than away from it.
Yeah, and we've actually seen pretty reasonable profit growth. I mean, that's one of the major reasons for that is we are seeing a very small subset of the market growing quite strongly, and the rest of the market going backwards or really not growing at any great rate. And so I think that's where from our perspective. We've sort of had a lot invested in the US, but I guess it's worth also noting that when you're talking about the US and investments, most of these are multinational companies that happen to be listed there, or maybe not. Maybe "happen's" a bit strong of a word, but it's you are looking the global reach, and that's really what the question of where they're listed is in some way different to how you should think about them from an investment perspective. So we've got lots of companies. For example, there's Eli Lilly in the US, which is a weight loss drug, and there's Novo Nordisk in Denmark, which is also a weight loss drug. They've both got global markets. They've both got effectively the same, competing with each other. One of them happens to be listed in the US. One happens to be listed in Europe. It's not really you're not really taking a bet on Europe versus the US when you're doing that. You're really taking a bet on that entire global market. And similar with something like a Microsoft or Google or Meta is you're really taking a bet on what it's going to do in that global market. Well, for most of those companies, global market ex China, because most of them don't actually operate in China. But yeah, that's how we look at it.
And just briefly on the the rules-based order, I think it's quite fascinating that China, who of course has imposed 15 or 10% tariffs back to some of the US, think oil and gas, for example, and things like that, but they're also taking Trump's tariffs imposition on them to the World Trade Organization, which I think is quite, it's quite fascinating. Well, who's actually calling the shots, who's running the rules, and who's benefiting from those rules. And I think it's quite interesting that you could argue that in some ways Trump is going round some of the traditional rules that have been, actually quite aligned to the US and quite strongly supportive of the US until quite recently. And now China is saying, well, hang on a moment, you're breaking the rules. So I find that quite a fascinating thing too.
Well, and this is the part which for me is the most important thing, I think, over the next 12 to 18 months that we're going to work out, is that, and it's less about, it is about China as well, but I think it's more about the internal systems within the US, is that, we're speaking about a rules-based order globally, but it's being, the tip of the spear is really within the US, where Trump is effectively doing stuff this time around that got him impeached last time around. And I think there's, there are factors that he's just pushing the envelope in terms of being, there's rules which Congress has passed, and he's, obligated by the Constitution to enact, and he's basically saying he's not going to do it. There is, he's clearing himself of all the, whether it be FBI agents who happen to work in January 6 cases, or he's clearing out inspector generals, or whatever it is. It's all the corporate governance things he doesn't want, and so he's clearing that out. There's a lot of firing of people, and a lot of these strictly constitutional things, which he's basically just running over and just saying, well, that doesn't matter. This is what I'm doing. Now, they're being challenged in courts, and courts are by and large holding up, the expectation. So, and I'll use one example, which was the, he's going to stop giving money out. He's going to pause all the loans to all these different charities and all these extra groups in the US. And, almost immediately that was sort of challenged in the courts, and the expectation was the judges were basically saying, yes, that looked like they were going to put a stays on it, and then Trump flipped and withdrew it, but then is saying privately that no, we're just going to do that anyway. So we're not even going to go through the courts for it. We're going to pretend we are doing it, but then we're not. And so this is, and I guess where I'm looking at is, it seems like it's really going to be a crash or a crash through. So he's going to put the US legal system under an extreme amount of pressure, and he's either going to be caught up in courts for the next 4 years trying to do stuff that's unconstitutional and trying to fight to do it, or he's going to successfully ignore the courts, or maybe the Supreme Court will the 3 or 4 votes at least that are going to vote for him on some of these extreme ones, and maybe he'll get his 5. And he'll push through, and you've lost the rules-based order, and much of the legal system in the US that sort of relies on that rule of law is going to disappear. And so that's what's being tested. And I don't know what the answer is. I don't think anyone does, but he's certainly very keen to test it in as many places as he can.
Yeah, and partly I think the thing about Trump is that he's still quite unpredictable, right? So if you look at the story of what's happened with tariffs over the last week, right? He went heavy on Mexico and Canada, and in both cases they sort of offered him a bit of a peace offering with regard to stronger protections at the borders, and now he's pedaled back. And I think the thing to underscore is that Trump is a wheeler and dealer. He's a deal maker, whether you call it the art of the deal or whatever you call it. I don't think there is a pure ideological position necessarily. He's got some fundamental things that he believes in, but nevertheless, it's about deals, it's about leverage, it's about pushing people in a particular direction and using, the force of personality and the force of I suppose, tariffs and everything else to get what he wants. Which is interesting. And then, of course, he surrounded himself this time with effectively foot soldiers who are definitely aligned to his particular interests and point of view, which was different from last time. So yes. The chances are, I should say, that he could do quite a lot more than last time around with less checks and balances. And therefore, the consequences could be quite material. as you say, abutting against the courts in places, but, Supreme Court is, of course, a bit sort of tilted towards him rather than not, possibly. So it'll be very interesting to see how this all plays out. And I guess coming back to signal to noise, there are consequences of some of these things that are playing through, which could well influence investment decisions ahead. So this isn't something you can just say, oh, well, we just ignore it. There are important questions that need to be asked.
Yeah. And I'm going to posit one sort of analogy, which I think is quite apt in terms of these, is that if you look at the financial sector and consumer protections that were all put in post the financial crisis and sort of beefed up a little bit, he's basically trying to abolish that entire department. And so I think that falls along with a number of these factors in terms of saying, okay, you get rid of your governance, you get rid of your watchdogs, you get rid of the corporate governance, and what does that mean? Okay, well, it usually doesn't mean that the world falls apart straight away. You get rid of all the constraints on the banks and let people, basically lend as much as they want to whoever they want and things like that. Usually you get a boom first, and then you get a big bust, and it could take 10 years for that to happen. And then everyone turns around and goes, oh, if only we had have had that organization which we disbanded 10 years ago, this might not have happened. And so the question for all these is, what's the timing like? Is it a question of like, okay, this is disbanded, right? Everything falls apart 3 weeks later. And there's some things which I think if you push through too hard, that could well be the case. That thing about trying to remove all the payments to all the charities and all these groups that are doing all these things, you could create massive havoc, pretty much immediately. But the flip side is there's other ones which you'll remove and you won't even notice until you get a boom and irresponsible lending and all these other things, and then finally you get the bust. And so it's trying to work out which is which, and how seriously do you treat these? And if you come back to the whole tariff one with Canada, I mean, I still don't know what he wanted from Canada. Like, I don't know if you can tell me, Martin. Like he obsequiousness. He basically wanted Justin Trudeau to grovel. It seemed to be. I don't know if you've got any other insights into what he was looking for.
Well, he does seem to think that Canada is the next state of the US, really, right? So I guess it was about just underscoring power. And of course, the Canadian situation is awkward because of Trudeau's, impending departure and all of the things there. And it must be said, of course, that Canada is intrinsically linked to the US. If you look at, for example, the way that manufacturing of cars work between.
Absolutely.
It's not just one movement, but actually quite often one component goes up there and then it comes back. And then, so actually this could go backwards and forwards quite a few times and create.
Yeah, you can add 100% to some of these parts because it is like 25%,
correct,
as they keep bouncing back and forth.
Correct, exactly right. And that means, of course, that the implications for Canada are quite significant and serious. Now, of course, they'll be looking to find other markets for some of their products and services. And I suspect, of course, some of their exports, minerals and what have you, there are lots of other places around the world they can probably go there. But some of this other stuff is much more difficult for them because they're so wired into the US. So in a way, Trump is just reminding Canada that, well, you may be a separate country, but are you really?
Yeah. Well, but and it really is. It works the other way though as well. Like most of these are the US car companies that have all the parts manufacturers in Canada, and so they're the ones who are going to Trump saying, "Hey, just this is going to wreck our business." And so and so it's great to say, look, why don't you do all this stuff in the US rather than in Canada, and we'll have all the stuff here. And you're like, fine, that's you can get there by industrial policy if that's what you want. But you don't want to blow up your supply chains, 10 days into your presidency, in order to get something that's going to take 10 years to get there. And then the other thing I think in terms of Canada is, the announcement that they made effectively is, I think whatever it is, they're going to put close to 10,000 people on the border, and they've already got 8,500 people in their border thing. Like it feels like it's an announcement for the sake of making an announcement. Mexico is a bit different. Well, initially I thought Mexico was a bit different in terms of it being, look, that's where there was a lot of backdooring of Chinese goods through Mexico. And the question is, is there something further that they're going to do there in terms of trying to limit that? And I think Mexico is trying to genuinely limit that. I'm not, completely on everything that's going on in Mexico, but it does seem to me that adding 10,000 more people from their army onto the border isn't going to make much difference, given that there's pretty high levels of bribery throughout the army. And so, it does seem as if he's very much looking for, and he would be well aware of that. It does seem he's very much looking for a heading out of this rather than a genuine. He wants to be seen to be doing things as opposed to feeling like he needs to genuinely actually be doing stuff. The bigger question is then, is that true also of China, or is China for real? And certainly within his inner sanctum and the main sort of economic people he's got with him, they seem to talk as if Mexico and Canada are just about posturing and getting using the art of the deal to get whatever it is he wants at the moment. But China is genuine. Now, that's what they think. I don't know whether Trump thinks the same. That's the question with all these, is that, does Trump, is he a believer that, yes, I'm just posturing to get out, whatever it is I'm looking for out of Canada and whatever, sound bites I want and headlines I want to get out of Mexico, but I'm really going to do this to China? Or is he just looking for, he's looking for a bribe? I mean, if China turned around, we were kicking this around the office the other day, is that if China turned around and said, hey, Donald, I'm going to buy $100 billion worth of Trump Bitcoin, whatever, Trump meme coin, in order for you to lay off on the tariffs, I don't know. Is that it? It seems like basically the way the Supreme Court's framed it seems like that might be illegal.
Mm-hmm.
And they don't even need to. They don't even need to announce it. They can just do that in the background somewhere and do it through back channels and whatever, and effectively bribe their way out of it. I don't know if that's successful or not, or does he genuinely have? It would seem that based on what he did last time, he does believe that China has been flouting the rules and they need to flip back to doing more domestically. But is that a genuine belief, or is it a bribable belief? And these are the parts we just don't know. And so I think, being too certain about anything, I think within these markets is going to be difficult.
Yeah, and Cookie says all about division because he has no policies to help his people. Well, that may or may not be true. Certainly, if you look at the base believes, passionately in what he's after, although actually I'm not sure they're necessarily that clear. But let me just come back to this issue about the rules-based order, because the question I've always had is, this set of rules, which of course is very much aligned to supporting US interests and sort of spilled out over, has always bugged me a bit by asking the question, well, who benefits from this rules-based order? And the truth is that Western countries have benefited much more than many other parts of the world, which is an interesting observation.
I would actually, I think you've got the first part of that right, Western, and the first two letters is right. But I would, rather than countries, I would insert companies have benefited.
Fair, good point. Yes,
because they're the ones who get the open, trade lanes and the channels to be able to sell goods and to be able to use them. Like that's the, that's really what has been driving this. And I think in terms of the countries themselves, it's mixed. I mean, they certainly benefit overall, and I think everyone benefits. With a these things are all pendulums about how much trade and too much trade, and everyone benefits until people start flouting the rules and trying to capture too much of the. If you've got completely open, then you get some countries. What I mean by that is some countries will then keep their currencies low or keep their wages low and try and be massive exporters and not allow their currencies to rise and get back to the even things out. So in theory, when everyone is doing this fairly, somebody produces, say Germany starts producing things very efficiently and they've got all these exports, And so therefore the currency rises, and German people are now wealthier and start buying more things from overseas, and people buy less of the German products, and things even out a little bit. Whereas Germany sort of put through a lot of rules to keep the wages low, and especially as they're stuck in the euro with all these other countries, and that sort of allowed them to have these massive exports. And I think there's a pretty reasonable case to be made that China's done something very, very similar, and they've managed to keep their wages low. They've got a record low consumer share in the economy, and that allows them then to export all these goods and effectively take this keep their own population employed at the cost of employment in elsewhere in other countries. And so there is some justifiable complaints about that. Companies have benefited greatly from it, but it hasn't always been the people involved who benefit. And so I do think there's I'd like to think that there is a reasonable amount of the gaming of the system that China has been doing that will be unwound, and it's certainly, we've been headed in that direction basically since Trump started it last time. I think Obama ignored it and allowed it to happen with a view that I guess China in the world it'd eventually become a democracy, and then it didn't. And then I think Trump started it, Biden kept pushing it. This time around, I think we'll get another decent push towards it, and so hopefully that'll end up in a good place. But I'm concerned that maybe bribery and other things will stand in the way as well. So, yeah, and with all these things, everything's right in moderation. It's a question about what is moderation, and that's I think there's potentially there's a bunch of things that got pushed too far, and so that you do need some protections for local jobs, and trying to work out where the pendulum sits is, I guess, what politics does.
Yeah, indeed. And it's worth, I think, talking about politics from just one other angle. Think about the UK, who is straddled now between, on one hand, the US and wanting to do a trade deal with the US, and on the other hand, trying to actually cozy up with Europe to an extent, right? Because it's still a big local market. And so you have a Starmer, I think, doing the splits between Europe and the US, and Australia, which is doing the splits between the US and China, because, of course, China is by far the biggest exporter for Australian goods. So some of these smaller countries like the UK and Australia seem to me to be really caught now between, where should the balance be between these various power plays? And that has an interesting consequence, both in terms of government policy and I think also in terms of the investment strategies for companies looking as to where to focus. So there are some really interesting consequences from all of this shifting of power.
Absolutely, and Australia is a small country with very open borders and borders in terms of export, import, and trading, very open trade borders. And that's of all the countries in the world, we've been one of the biggest beneficiaries of the open trade policies, and the US effectively guaranteeing security for trade. And so I guess we've got some of the most to lose if that reverses.
Yeah, absolutely. And as Otto says, it's going to be hard to navigate the shifting sands, which is obviously true. But of course, you are invested in the market, and you have funds from investors looking for some degree of return and some degree of protection. So what are the signals that you're looking for? What are the sort of the pieces of data that actually drive your thinking around some of this stuff? Yeah.
So the first one is that we are under the expectation at the moment, and then this is I guess I'll preface this by saying this, it's a view we think is true, but we're not quite sure. I think there's a lot of stuff in the Trump world you need to be recognized that you don't know. Yeah, but the view we have at the moment is that the only thing that will discipline Trump will be the markets. And especially given, as you said, he's surrounded himself by yes men and sycophants and people who probably won't give him the truth about what's going on. And so that might be true for, there's probably some domestic policies and things like that can play out that might have damaging consequences that you won't know about, and he'll just push them through regardless. But the stock market is something he does watch, and it is something I think he counts at least some of his. There's a certain amount of pride he puts in terms of his views on that, and our expectation is that if there are things, say tariffs on his largest trading neighbours, that suddenly see the stock market start to take a bit of a tumble, that he will reconsider his positions. Now, are we sure, absolutely positive that's right? No, I'm not. But the expectation, if that is true, is that look, there's going to be blowups consistently, and that you're going to be using the downturns to pick up some stock as if markets fall 5% on the concerns of this or 10% on the concerns of that, is it now worth picking up stock? And most of the time, we think the answer is probably going to be yes, until the day it isn't. So that's it's probably not much help to you, but it's I guess it's a way we're treating this is that there's government bonds is one concern, the bond yields, and then the government bond yields and the stock market, the value of the stock market, and we think they're sort of relatively inextricably linked insofar as if you start seeing him trying to push through policies that are going to be pushing inflation too hard, then you would then start to see stock bond yields up, stock markets down, and I think that will bring some pressure and make him reconsider what he's doing. I think one of the good examples of that is that if he had gone ahead and put these tariffs on, and not to say that he might still do that, but it's probably going to add close to 1% to inflation. And if the Fed's turning around in 9 months' time, looking at inflation up, another 1% on where it is, it's going to be thinking about raising rates, not cutting rates. And so there might be a little bit of look through. Maybe they'll go, oh, well, let's wait and see how much washes through after all the tariffs. But they're certainly not going to be cutting rates. And I think that's that expectation is pretty key. And then the other one is that look, companies, there's probably a fair bit of greedflation sort of still. I think if you're going to be mucking around with the tariffs, there's a reasonable amount of greedflation I think that will seep back in. And so I do think we'll see some more tariffs on China, and I think that'll help companies to expand their profit margins. I mean, most of the studies they had from the last set basically looked at how much prices rose, and then the companies just tacked a little bit on the end as well, and sort of yes, I'm not actually subject to a tariff, but there's some competitors, or I can blame that on my latest set of price rises, and sink that through with my customers. And so I do think there's it's not necessarily bad news for companies. It's probably bad news for the economy of the US, but it's a tracking how bad that inflation gets is going to be pretty key.
Yes, and it is, I think, very interesting. I mean, Powell last week really all but said, we've got to wait to see what happens, but they were already thinking about some of the implications potentially. And as you say, the rate path in the US, you look at the yields are higher than they were and will probably stay so. That's putting upward pressure, of course, on the cost of money in other places too, which will be interesting. Whereas, of course, in the ECB, they cut again. And so they've got this contention between the rate trajectories in various parts of the world. I think that's a very important signal. And, if you think of the Australian situation, where we have weak growth, we had the CPI just slightly below expectations, but then partly muffed because of the numbers and the way that the government support flowed through. It swamped effectively the metric to the point where even the underlying was also down probably lower than it was. So, you got to say, well, there's a really interesting conundrum there, because if we do cut rates in Australia, whilst rates are higher in the US, that's going to put potentially more pressure on the exchange rate, right? And exchange rate, of course, it means that our imports are going to be more expensive, which is going to put inflationary pressures back into Australia. So that's a bit of a conundrum.
Yeah, and it's also the conundrum the other way around for the US. Like the dollar's been so strong, and that now all of a sudden, like I can see it in the earnings figures, we started to see it at the margin downgrades to company earnings, because they do generate a lot of their money from offshore within the US. But then you're looking at the US and going, well, that's going to be generally that's going to work exactly the opposite way to what he wants. So he wants more production in the US and less overseas. But if he's sort of throwing tariffs on there and the US dollar rises 10%, well, US dollar rises 10%, he sticks a 10% tariff on money on goods coming into the US. Net, it's a wash. You can still, if you're producing a good for 100 euros in Europe and selling it for $110 in the US, and then the US dollar rises, now you can still sell it for 100 euros, but it's only costing you $100 in the US. And so, the $10 is just going to the tax department, but the European company hasn't changed. It's just the US consumer that's sort of ends up worse off. And so, I do think there's I don't want to make Trump sound not intelligent about these things, because I do think he knows the effect of it, and because he did speak about having in some of the campaign stuff, he spoke about having a weaker dollar to encourage more exports and all that type of stuff like that. But I do think as well he likes the idea of a strong dollar. Maybe might just be the sound of it. I don't know, but because he does flip between whether he wants a strong dollar or a weak dollar, but he's if he wants more US exports and fewer imports, then he wants a weaker US dollar. But that's not what's happening. His policies are pushing the dollar in the opposite direction, and so that's one of the reasons why we're staying invested in the US is that I think I spoke to you a little bit earlier, but I look at the values of my portfolios and over the weekend, all the prices fell in the US Friday night with the announcements of all these tariffs, and then I looked at the value of the portfolios and I thought I'd done something wrong because the values had gone up, and I'm like, and then I was like, oh, actually the currency, the Aussie dollar, has actually fallen more than what the markets had. And partly that was just timing. The markets were closed for some of the last bits, and the currency markets were open. But it's just a sign of how the Aussie dollar acts as that shock absorber for Australian investments overseas, and that when things, particularly in tariffs, if you're thinking about where should I invest and I'm worried about tariffs, then you are better off with an international investment, insofar as if the big tariffs start tit for tat tariffs around the place, the Aussie dollar is going to keep falling, and that's going to help, which typically wouldn't do 100%. Like don't expect to get it all back, but it's going to shield you, maybe half the fall. I would expect as a general rule for you to save on currency weakness.
Yes, and of course a lot of the stuff that we sell is sold in US dollars, right?
Yes.
So as it converts back, that funnels back effectively greater earnings back into Australia too. So the government might do quite well, right?
Well, okay. So here's the part. Yes and no. One is resources companies aren't really Australian companies. They're global companies that happen to be listed in Australia. So BHP, I don't know how much it sells to Australia of what it produces, but it's a small fraction of what it sells to the rest of the world. They report their numbers in US dollars. So does most of the big mining companies do. And energy companies as well. Someone like Woodside, they report their numbers in US dollars because that's the currency that matters. In a way that they've all got currency mismatches in that their revenues are in US dollars and their costs are in Aussie dollars. So that's one part. So that's where absolutely, as a broad brush, if the Aussie dollar is falling, then they're better off. The flip side is, well, why is it falling? Because if it's falling because their biggest customer, which is China, is copying it on the tariff fronts, and global economic growth is slowing down, then now, does that outweigh the currency effect? And for me, yes, I think it will. It is worth noting that most of our major exports, coal in particular, and iron ore, are still well above the prices at which it's economic to go out and build new mines. And if you get that continued weakness in terms of the construction in China, then coke and coal in particular and iron ore are going to keep falling. And I could easily see them going to, if they went to $60, the Aussie companies would still be profitable and making money at those levels. And so, if you actually wanted to start really washing out a reasonable part of the cost base, you'd need it to fall much lower than that.
Absolutely, and it'll be interesting to see how that flows through into whatever budget projections are used up to the election or not, right? Because they had a big hollow log insofar that their forward projections were assuming that the iron ore price would drop quite significantly.
Yes.
Right? But the iron ore is actually in US dollars.
Oh, yeah.
Funny that.
So, that's right. Yeah, and then this is why you need sovereign wealth funds and stuff like that to take the windfalls when you have and sock them away. Don't give them out in tax cuts like Australia is wont to do. So,
but then the downside is that the price of LNG, which is priced in US dollars, right, means that
doesn't matter because we don't make any money from it.
No. But the point is that locally, those costs will be higher too.
Yes, that's what I'm leading to. That is theoretically, if you're an energy superpower and the LNG price goes up, you should be looking at it saying, "Great, we're going to make more money as a country. We're going to have more dollars flowing in for government revenues, and that's a good thing." For Australia, it's not. We've stuffed our energy policy so badly that now higher energy prices. Yeah, the government makes a tiny sliver of what the private companies are making.
Yep.
The private companies are almost all overseas companies, and the ones that are listed here are pretty reasonable overseas shareholders anyway. And so the effect of all Australians paying, or not all Australians, all East Coast Australians and South Australians paying higher prices for gas, just that far outweighs any slight benefit we get from the very small bits of revenue that come through. So yes, it's
it's a big deal. And in fact, the show that's done the most this year for me was the one on this gas conundrum, right? Where effectively, clearly, policy is stuffed up for 20 years plus, and we're now talking about importing gas back into southern states, right? At international prices. It's ridiculous, really. Couldn't make this stuff up, but it's a long-term, literally stuff up, and it's really hurting. And of course, that's putting higher energy prices into the manufacturing sector, which is squeezing manufacturing even more in Australia. It's putting significant pressure on households. Governments are having to use a lot of money to be able to try and keep the inflation down a little bit and support households. But that's still taxpayers' money being spent. So you could not make this up.
No, and it means that some of that benefit of the Aussie dollar is being lost. Usually what would happen is the Aussie dollar would fall. Now our manufacturers are more competitive. We're down from whatever, close to 70 cents not that long ago, back to 60 cents. All of a sudden our manufacturers are, 15% more competitive. Now we can start growing and expanding the economy. That's the benefit of floating currencies, is that's what it's meant to do when things go badly. But we've stuffed up our energy policy so badly that, our manufacturers got this great benefit from having lower prices. In the meantime, they've been smashed by the higher costs that because of the energy that's all being imported. So it's that's the type of problem you usually see in sort of small, poorly run economies. And
what are you saying about Australia?
We're a large poorly run economy. That's what I'm saying. We're sort of in the top 15 economies worldwide. But yes,
absolutely.
Anyway, but it does mean the same shock absorbers that might have worked in the past are not. They're partially there. They're just not the same as
not as impactful as previously. Well, we've spoken about the trade situation and the trade wars, but the other big news over the last week or so was DeepSeek and the AI story. And these things are not completely disconnected from each other in a way, because of course DeepSeek was a Chinese-based solution to AI, which looked superficially cheaper. It sort of used open source. Did it steal stuff from the US in terms of inputs into it? Did it use chips that they shouldn't have used? Nobody quite knows. Although actually, I think a lot of that is probably just noise. But the AI situation reacted, so we saw significant falls. Nvidia, for example. So is this a significant shift, or is this just again noise rather than signal?
Well, there are some important things happening. Like, it's not a small. They did make some reasonable breakthroughs in terms of it, but I think it's being read the wrong way. So I'll start with a couple of things that I'll start through the story. I'll take it a little bit step by step. So one of the interesting things is DeepSeek. It wasn't one of the big Chinese IT companies. So this is not something specific to China, but it was a hedge fund. So it's out there trading, trying to, it's got AI researchers working within it, and they've got them trying to work on models to try and predict share prices or what to buy and sell. And so you've got Baidu, Tencent, Alibaba, these massive massive Chinese companies spending bucket loads of money. They didn't come up with this. This was a small company or smallish company. So they speak about the processing power that they used in order to the dollars they spent on the processing power, and that was very low. What they didn't talk about was their hedge funds that's probably paying tens of millions of dollars in salaries to its employees. Multiples of what they spent on that processing. They spend a lot of time optimizing the process. So a lot of time was actually about saying, well, how do we can't get the chips that we want. So how do we optimize the process to use these cheaper chips or the older versions to get to the same place? And that was really the secret to it, was how it was the productivity benefits they got in terms of that. And so it's less about this saying, oh, let's pick on this small number of the actual processing power and compare that to the 100, whatever it was, $5 million for them and $100 million for someone else. And it's saying, well, yeah, but that wasn't where the benefit came from. The benefit came from the process improvements. And so there's one part of it. Secondly, it was trained on NVIDIA chips, just far fewer. And maybe there is some black market. Maybe they didn't admit some of it because some of it was black market or whatever. But DeepSeek wants better chips. Like, they're not turning around saying, "Hey, give us your worst chips." They would prefer to have better chips to run this on and be able to do it. And because it's open source, they're showing how it's done. The types of improvements they've got are going to be run by all the rest of the AI guys. So there's that part. I think the most interesting or the most shocking thing to markets was really that it came from a Chinese competitor. But this has happened twice already, that we've seen these big jumps from quite small companies. So he started with Google was sort of started with this as the leader. They published some papers to say how they were doing it, which everyone so far has been basically copying the Google process that uses these graphics processing units. And so OpenAI basically piggybacked off and stole stuff that Google had sort of put out there, or stole, but standing on the shoulders of giants to do the next stage. Then we had I was going to say Cognizant, so wrong. Claude, complete mental blank on the company behind it, but the company that runs Claude, they effectively did the same thing as well. They sort of piggybacked off what was happening. They used some of OpenAI's model to help train their own model, and they were a relatively small company, and now they're much bigger. And then you have DeepSeek doing the same thing, piggybacking off. And so it's not saying it's not possible. But we've seen it a few times. It's in the early stages. The companies are gearing up and spending a lot more money on these. To me, it's sort of analogous to the one I was using was Leicester City winning the Premier League in 2015. You've got this small club in the world's richest soccer league, and they spent a fraction of what all these other clubs did, and they won the league. Okay, is that a sign that then for the next 20 years, small clubs are always going to win the league and the people that spend the most money aren't going to win the league? No. For the next 10 years, we had the same 3 or 4 clubs winning that over and over again, and the ones that spent all the money. And so that's the question about these, is saying, okay, what lesson do you learn from this? Do you learn that small companies are always going to beat big companies, or do you learn that sometimes small companies can beat big companies? And that, so there's one part there, but it's worth noting that, look, the companies that are leading that area they haven't got as wide moats as what you might think. So if you think about OpenAI, Google, within the AI part of it, Facebook's sort of also ran in that, and the Claude ones, they haven't got these.
Oh, your audio's just gone off. Can't hear you now.
Sorry.
That's all right.
Do you want me to...
It's come back on now.
It's come back on?
Yeah.
I'm getting an internet connection is unstable.
Oh.
I am hardwired in here. Hopefully it's not going to head down. Okay, so that's one part of it. The next part then is saying, what does this actually mean for the processing side? Now, if you can do something 10 times better, so let's say that's the right number. This is going to be 10 times cheaper to train it. So does that mean all the CEOs go, great, I can now, something that used to cost me $100 is now only going to cost me $10. I get to cut my budget by 90% and off we go. Now, if that was the case, yes, this is a major, major problem for NVIDIA, but it ain't the case. At the moment, people are going, right, I can be now 10 times more efficient on the stuff I can learn. I'm going to be doing 10 times more of it then, because I'm still spending my $100 I was going to spend. I can just now do 10 times as much, and I can get better results, and they're cheaper, and I can push it out. And the analogy which I think suits this one the best is ADSL. So back in 2000, we have this, we're putting on all this internet. Everyone's trying to get internet speeds up as fast as they can. We're adding fiber all over the place. There's satellite stuff. Everyone's trying to get faster speeds because we just don't have fast enough internet download speeds. Then somebody comes up with this bright idea of ADSL, which is effectively using existing copper lines, but it's saying, well, it used to be we need the same speed up as the same speed down, but you know what? For the internet, you don't. You only need, most of the time, all you're doing is sending clicks in one direction, and then you're bringing videos and stuff in the other direction. So fantastic, 10 times better. We can send 10% up and bring 90% down. Great technological innovation. Now, did that mean everyone sort of went, don't need fiber anymore? No, we can stop, no more development. Not a chance. All the companies went, that's fantastic. I'm absolutely going to use that. But the internet isn't fast enough to run these videos. It's not fast enough to do all this stuff we want to do with it. We're going to use this productivity gain, and then we're just going to go and do more of it. And that's what I'm looking at for AI, is saying it's not about saying we've reached the end, victory is here. We've done everything we could ever possibly do with AI. Now we're just going to start taking the cost savings. It's about saying, no, we're going to spend there's a race on to get to as much artificial intelligence as we can get to. The next stage is the what do we call it? The agents, the AI agents, and that's where I've got a chart up. Actually, let me bring up this chart that I wanted to show. So this is one from actually pre DeepSeek, and it might be a little unclear. I'll have to explain it, but it's basically saying on the bottom we've got this cost per task that you're running, and this is all OpenAI models. And then on the left-hand side is a score they got on some private evaluation, ArcAGI private evaluation. And right at the bottom, we can see this O1 Mini that costs almost nothing to run and gave you 7.8% on the score. Or you can sort of jump up to some of these other O1, the low, medium, and highs are sort of scoring 30-odd% and costing you somewhere between $2 and $5 to run in terms of the process. Then you've got this big jump up to this O3 that's running where it's a O3 low, where it's been tuned to whatever so it's basically spending a lot more time. Tuning is basically meaning trying to get it right for the task that it's doing. So rather than making sort of very general model, sort of very much focusing on the task it's trying to do. And then way up the end there, we can see that you can actually get 88% score on this test by spending over $1,000 for each task you want to do. So what this is telling us is you throw more processing power at it, you get better results. Effectively now you can just decrease all these by a factor of 10 and shift that whole curve to the left, so that what's costing you $1,000 now might cost you $100, and what was costing you $20 down here might end up costing you $2. But it's still about that. We're not sitting at 100% looking at these as cost savings. We're looking upon this as a chance to get better performance out of the models. And so it might mean that programs that might otherwise be sort of kept only for the most important tasks now get used for other tasks. And so for me, I look at all the budgets for all the different companies that are out there opening data centers, and not one of them is saying, I'm going to cut my budget because of this. So so that's sort of the core to it, is that for me, this is an opportunity. Maybe something will come along that'll be better than the NVIDIA chips, but we can't see anything at the moment, and that's a fair bit harder to do in terms of that side. And the other thing I just want to bring up, it's a chart which I've shown it before at a couple on ones, and we spoke about this. Some of those we spoke about this was the strawberry, so it was the latest version of the OpenAI. And we spoke about how they used to spend all this time on pre-training, which is I'm building my model and putting in the inputs and trying to work out what are the right outputs. The post-training, which is like, okay, I've got my model, now let me test it and make sure it works and spend some more time working out what it's doing. And then the final is the inference. Once we've got a working model, how much power it needs to use. And it was all very much on the training, which is all where very much is NVIDIA, and only a tiny bit on the inference. Some of these later models, and those are those ones you saw up the top of that curve, those tuned models, were spending a lot more on inference. And so they were doing stuff on training. And then so the question was, okay, is there something better to do the inference on it? The NVIDIA chips are pretty good are the best at doing the pre-training and the post-training, and they're pretty good at doing inference, but maybe something else will pop up, and there's a few people out there trying to create them that will be better at inference, and that's where they might lose if this happens. Now, this DeepSeek model is back to that first stage where you spend a lot of time on the training, and then the inference's cost is still pretty small. Now, it's not to say we won't flip back again to this other model where inference is bigger, but it's in a way, it's actually a positive thing for NVIDIA in terms of saying, well, if that's the way, if they're the models that are going to be going to run more easily, you spend all the money on training and not much on the inference, then that's a better thing for a company like NVIDIA than not.
Yeah, and of course, as the cost comes down, it means that the penetration potentially of the capacity of AI to do things will also increase. So it's not like this is the end of something. It's more like this is the next step up in a significantly enhanced future where AI is applied to more and more and more and more things. That's a lower price point.
Yeah, exactly. And think about, if you thought about a simple task, you say, okay, let's say we're at the shops and the cameras are watching what you're scanning, self-scanning, and it's working out what fruit you're putting through. And so you can theoretically get to the stage where you just don't need the checkout people, because it's accurately identifying what you're putting into your trolley way better. You're saying, okay, well, if that was going to cost $5 to run that process, then there's a certain number of stores would do it, and there's a lot of stores that go, well, for $5, I really want to spend $5 for every person that goes through my checkouts, particularly if the value they're coming through is low. Well, if that's just decreased itself to 50 cents, all of a sudden, a lot more companies are like, well, okay, for that level, if I need that level of accuracy, it now costs me 50 cents per customer rather than $5. Now much bigger audience for people that are interested. And if you get another sort of 10 times, then now we're back to 5 cents and everyone's doing it. So So that's one part. So I should run through some other companies though, because this isn't just NVIDIA. So the question is, so I sort of go through the big, let's look at some of the big companies and how it's going to affect them. I'll start with Amazon. So for me, this is probably a positive for Amazon. So they don't do a lot of the AI themselves. Anthropic, that's the one. They do have a share in Anthropic, which runs the Claude, but it's not a major part of their business. Most of their business is building data centers, selling the space in that data centers. So the worst case scenario for them is that China decides, you know what, we're going to fund free AI in order to vacuum up everyone's data. And that's potential, but I think there's certainly a lot of companies coming out saying, well, no, you're allowed to use OpenAI, but we're not going to let you use DeepSeek. And the question is about what China's going to do with the data and all these things like that. But maybe that's out there that China will decide to try and get as much as it can and subsidize the same way it sort of same way it did with a lot of the solar, where it effectively said we're going to subsidize all this solar, everywhere else in the world will go broke, and then we'll be the only ones producing it. Is where they try and do something on the data side. I doubt anyone's going to let them, but it's possible. If you look at Microsoft, that's very similar to them. They've got an OpenAI. They have an OpenAI investment, so that's weaker, obviously, given that. But they make most of the money from running those data centers and running that services for people. And the other thing is the switching costs are really low. And so, and they've already got it as an option. You can just choose who you want to use when you're in the back end. And most of the software that's out there as well, most of the programming software where you're using AI agents, you can flick between who you're using. And so, just one more competitor in that space, so it isn't that damaging. Alphabet or Google has got a lot of elements of those two, where they do a lot of their work through the data centers as well. It is probably a little bit more negative for them in the sense that they are, these guys were the leaders. They were there. They were in front of everyone else, and they've been caught a couple of times now by these small ones, OpenAI and then Anthropic and now DeepSeek. So that's sort of slightly concerning from that perspective. I think if you look at, I've got a chart up just to show, which is what was lost was that Gemini actually came out with their 2.0, and I've just got the prices that they were versus DeepSeek, the DeepSeek R1, and they're cheaper on every measure just about, and so it was lost in the whole washout. But we'll be interested to see whether they can. They do have a little bit of leadership at the moment, not that people have really noticed. But we'll be interested to see whether they can keep that as a, So it's sort of two-edged on them. They're similar to the data centers, but and they've got a great model that's came out. But on the flip side, it just shows that maybe these models, more small guys can pop up, and it might not be as profitable. Meta is, I think they actually rose on the day. So they have an open source AI model out there, but I think most analysts think of Meta as being more of a user of AI than a beneficiary in terms of a producer of AI. And so the benefits they get from running the AI over their websites are going to be more, and the costs that they have to spend in terms of getting the right ads and getting the people the right videos and all the different types of things they're doing is actually net beneficiary. If there's more of these guys out there, then they're actually thought of more as a net beneficiary of it. Who have I missed? Apple. So look, I'm skeptical that AI models will run on people's phones. So my expectation has always been that, look, the phone's going to ping a server somewhere that's actually going to run the difficult job of answering the question and then fire it back to them. But DeepSeek actually you get some cut down versions of it that run on people's PCs. And so I'm still thinking through that process, but I think broadly I'm right, but maybe more of it will be on the phone than what I might have thought. So maybe you'll have a model specifically trained just to recognize my voice on my phone, and so which might be 3% more accurate at picking up my voice than the standard model, and so and maybe that's enough to then get people to buy a new phone. And I do think Apple's going to certainly play on that. So I think the marketing will absolutely be there, that this phone's AI ready and does all these great things. I don't know whether the truth is there, but yeah. So I'm not a fan of So I'm sort of not a fan of Apple from that front. But this says maybe I was wrong in at least a certain extent.
So just on Apple, it's interesting because, of course, their concept is that you have the AI on your phone with a ring fence, so that's highly secure, nothing goes anywhere to the internet, etc. And then you can step beyond that, and actually you can step beyond that further into the great unwashed AI if you want to from that same application, but in a controlled way, right? So it's like they seem to me to be playing both ends to the middle, but I do think it's a marketing strategy predominantly.
Yes, yeah, exactly. And look, Tesla's not really in this mix, but it's worthwhile we're talking about the big ones. They've taken in terms of AI, they've taken a pretty big bet on something that most other, on a driving technique, and I won't get too much into the weeds on it, but basically on a driving technique that most other self-driving companies have chosen a different way, and the different way is more similar to what's happening on the with the DeepSeek the process. And so I don't know. It's still the $1 trillion question for them is, can they get will the method which they've chosen to do or the path they've chosen to do this, is that going to be more effective than the path everyone else has chosen in terms of AI? And maybe they'll be shown up to be right. Each sort of incremental bit of data that's coming out seems to be suggesting they were wrong, but we're a long way from the finish line. So, yeah, that's
very interesting. And just we'll put NVIDIA up just as a slide comparison. I've been showing the recent charts for all of the ones we've been talking about. So NVIDIA has come back.
Yeah, but I do want to highlight as well within that, some of that is that so at the same time they had developed a chip that sort of worked around the constraints that Biden's administration had put on them so that they could actually sell this chip to China. So they'd basically taken their chip, redesigned it, downgraded the capabilities to fit what they were allowed to sell to China. And then there's announcements basically coming out from the US government that actually maybe that wasn't, maybe they need to stick on new ones and they won't be able to sell that chip. So NVIDIA's down, but it's down partly because of that and partly because of where it sits in is hard to tell.
And just to say that if you look at the climb of NVIDIA over the last 2 or 3 years, right? I mean, it's been rocket ship shaped, so it's come back, but it's still significantly higher than where it was.
Yeah, and it's cheaper than Commonwealth Bank.
Yes, I know. That was my next point.
Yeah, if you want to buy NVIDIA, it's on. Well, the first year is still a little bit. If you look at last year's earnings, it's still expensive on last year's earnings. If you look at what it's expected to earn over the next 12 months, it's so maybe 20% more expensive than the market, 2025. If you look at what it's expected to earn the 12 months after that, it's back to basically maybe 5 or 10% above the market in terms of that. So yeah, and definitely on that second year forward, it's cheaper than the Commonwealth Bank.
Well, here is the CBA chart, right? And it's fascinating because it's still up there, and all the analysts are saying, don't understand why it's where it is. Some people are saying, well, it must be a technology stock rather than a financial services stock. That's the only way to justify it. But there is no way that on any banking analytical perspective you could justify the price of CBA relative to JP Morgan, let alone the AI industry.
No, not unless you figured that whatever government gets in is going to be allowed them to do whatever they want and make as much money as they possibly can with no consequences. So,
well, the Australian economy, as we discussed earlier, is looking a little bit shaky. Clearly, margins are under pressure at the moment. Although if rates, move, maybe that will give them some opportunity. But it is still not understandable. I don't understand, and I've looked at banks for a long, long time. I can't justify the valuation of CBA on any fundamentals.
No. As I said, I don't think anyone can, as you were saying. Sorry, I don't think anyone can, but
investors are still investing.
Look,
so.
yeah, that's right. It's a big bank, pays dividends.
Yeah,
those dividends are franked, so therefore people still buy.
But just come back onto the AI. So basically, the story here, because I believe that the initial reaction was overreaction. Because I think it was because it had the China tag attached to it more than anything, and markets were a bit shocked by that. But when you actually start parsing it back, the future of AI still looks to me to be relatively positive, insofar that clearly it's going to do and enable a lot of things to happen. We're in the foothills at the moment, but whether the first companies out the gate ultimately are the winners is the really interesting question. I mean, Cisco is a good example, right? They were first out the gate on the internet revolution. Look at them now, or indeed Intel.
Yeah, well, or I'll give you a better one. Well, Cisco's sort of more like the NVIDIA, but I do think NVIDIA's. I've spoken a little bit about this. NVIDIA's basically, I think their graphics processing units are similar to the Cisco, but NVIDIA, what they've done is they've redesigned the data center around communicating efficiently with the chips. And the new data centers that are being built are not the same as the old data centers. They're literally being built around how can we make big groups of graphics processing units talk to each other. And so if their vision for the future, if they're sort of driving both those trends, not only the chips themselves, but the whole process of how to make them talk to each other. And so, so they might have a bit more life left in them. But the other one that I find, I use this analogy all the time, is that people talk about these crazy prices during the internet boom, and in the early days, you can run through all these different search engines, Lycos, Alta Vista, Yahoo, Ask Jeeves. Like there are all these ones out there that have these sky-high multiples. Everyone knew, hey, search is going to be this fantastic thing. You need to be in search. Now, the ultimate winner was Google, but they weren't even listed at the time. They didn't list until years after the whole thing had all fallen apart. And so it's that part about saying, it's picking winners is difficult within this space. And so trying to say that, is it going to be Anthropic? Is it going to be the Google one? Is it going to be the Meta one? Whatever it is, nobody knows. But you can sort of pick some of the broader trends, and you can pick some of the losers from it. Making sure you're out of some of the sectors that are losing, I think, is just as important as being in some of these sectors that are winning, and also acknowledging which are the companies that are making the money from it. So at the moment, that's what I ran through in terms of Amazon as an example. Is these guys are building data centers and sticking computers in them that they're buying. Most of them they're buying from NVIDIA, and selling that space to people who want to run these models. That is what Amazon is doing. They are not throwing money at something that's losing money. It's not a pie in the sky thing. They're genuinely out there building data centers to do this and making money from it. And that's, Microsoft and Google within its data center business, they're doing very much the same thing. And so you need to sort of dissociate, especially when you're talking about a company like Google, which can be confusing, which is, okay, what are they doing from the data center business? Now, what about search? Might they lose their stuff on search? Yes, they might. What concerns do I have around that? Now, what are they doing themselves with their own Gemini? Where's that sitting versus these other ones? But I think what we've really learned is that Gemini part of it is way too early and difficult, and new competitors can pop up. And Anthropic effectively did the same thing as what DeepSeek did, whatever that was. I feel like it must have been a year ago now, maybe it's less than a year ago. It's hard to keep track, but Anthropic was basically the same. Here's a company came from nowhere, created this model. Isn't this great? Up they go. The investment from different people. The shock with this one was it wasn't a brand new company from America. It was a brand new company from China.
Yeah, and just for reference, this is the Cisco story. If we go back to 1991, you can see that the peak was around the 2000, where it actually was valued, towards 80 US. Today, it's at 61, but of course, you've got many years of inflation to actually erode the relative true value, right, over that period.
And if you look at the earnings of Cisco, it's this nice 45-degree line, maybe not 45, but maybe 30-degree line that just rises that whole time. It's a you look at the underlying business of it. Yeah, it's a great underlying business. It did what it thought. It just got overpriced, and that at the peak of it was like hundreds of times price to earnings ratio.
Yeah,
and that's the danger, is overpaying for these things. Now, the question with Nvidia is a great question. There is, so if you sort of assume the analyst forecasts are roughly right, maybe they're in by or out. A company in that sector, it's a nasty sector, that sector. Intel and Texas Instruments and all these guys are, there's a litany of 1,000 companies in there that have been leaders and fallen apart. You're only as good as your latest hit. You need to keep coming up and spending all this money on R&D. So the companies in it don't get priced that expensively. You probably pay 20 or 30% less than what you pay for the market. So Nvidia, it's on 22 times next year's earnings, the year after next's earnings. You probably would be paying, 14 or 15 times earnings, if that's what you thought. If you thought in 2 years' time that was it, that was all it was going to grow. And then it goes back to a sort of just a steady state, up and down the way all these companies go. So what's priced into Nvidia at the moment? For me, my expectation is you're pricing in that Nvidia is going to grow for maybe another 2 or 3 years, and then they're into steady state. So they grow, say, till 2028, and then that's it. They're back to just a normal company growing at whatever rate. And that seems to me to be too pessimistic. I can see 3 or 4 years of growth at least at pretty elevated rates, and then maybe there's a reasonable chance you can get out to 10 years of pretty decent growth, and then before you go back to a more steady state. Okay, now we're reaching saturation point. We're not out there rapidly building these things as fast as we can, and you're just a sort of normal growth company. So time will tell.
Indeed,
and it is one of the biggest companies out there, so obviously of interest to people, and particularly Aussie investors. People who don't have stocks like this in their portfolio. If it's come back. I mean, as I said, it hasn't come back that far, but it has come back, 20%. There is a bit of a chance to pick it up if you haven't got some.
Absolutely.
And you believe in the story.
And generally, some of those US techs have outperformed local techs here. There are a few that have done quite well here in Australia, but the US ones have done even better.
Yeah. And the problem with the Aussie tech sector is you're just very limited to what you're getting. So if you're looking for a broad exposure to these, let's say you're looking for a broad exposure to the growth in data centers. So we've got some of these tilts. You can just sort of pick. I'll take the data center groups, and you get sort of 5 or 6 companies, and you've got 60, 70% of the market. If you chose one of the Australian companies. Complete mental blank as well. And then there is one of the companies that does data centers over here. Complete mental blank on their name. Anyway, you've got one company in one area, and you might find that somebody else Amazon comes up with some amazing technology that means that these guys are left behind, or somebody else pops up with a different technology.
Goodman, I think, is one in Australia that has data centers, I believe.
Yeah, that wasn't the one I was thinking of.
No.
Anyway,
don't worry.
It'll occur to me in 5 minutes' time, like Anthropic did. Yes.
But it is interesting that the local tech scene in Australia is relatively limited, but it is one to watch. Now, I had a couple of questions that came in earlier on, which I didn't bring up because they weren't directly relevant to where we were heading, but I've got a little bit of time here. So this was one from Cookie Boy on Japan. So, of course, Japan is interesting because Japan has started to hike rates, right? So it's a fascinating situation where you've got the US who are saying, well, probably rates, will have to stay roughly where they are. You've got Euro cutting rates. You've got deflation in China. And yet in Japan, you seem to be in a different situation, of course, from a much lower base. So
Yeah.
Wondered what your perspective there was with regard to what they're up to.
So there's a couple of elements to it. One is I do have to acknowledge that it's Japan raising rates has been the kiss of death for economic cycles for the last 20 years. Every time Japan's like, that's it, we're done. We've finally got out of this deflation. Let's raise our rates. The opposite has happened, and they've been back to cutting rates without. So I think you need to keep that at least in mind. Look. Japanese rates are really low. As I said, we're like, oh, the bonds are up to like 1.25%. What's interesting is they've crossed with Japan, with China, and so the question now is, is there that, does that make sense? And certainly some of the longer term rates, for me, that makes sense. That the outlook for China looks worse than the outlook for Japan for me. I don't know if you've got there's a couple of people who've done I've got one handy. I don't think I've got one handy, but there's a Japan 30-year bond versus the China 30-year bond.
Yeah, I don't have those crosses available. I've got the Japanese 10-year showing at the moment, which is showing us at 1.273.
Yeah, that's right. Look, it's a long way to go for Japan. There is a pretty reasonable chance they'll be backtracking at some point, and there's an argument that goes, which is probably not as true as now, because Japan's smaller, is that sometimes the raising of the Japanese rates, which starts to unwind some of that carry trade, and so then there's a decreases leverage globally, and that sort of is a bad thing for the world economy, because you can't borrow cheaply in Japan anymore, and so the rest of the world markets come off a bit until the lending comes back. But I think that plays a part, but I don't think it's a major effect. I think it's one of those. It's directionally right, but it's not the major effect. It's not the tail wagging the dog.
And I think you're right there at the moment. And if you look at what's been signalled, we're talking maybe more, but maybe not too much more. And of course, then this global trade thing bubbling on behind might also change the story there. The other question that came up earlier on was on a different area completely, but I'm interested in your take on this anyway. This is from Perry New. Thoughts on buying property in central Sydney in the current environment? Now, I don't know whether this is commercial property or residential property. There isn't much residential property in the centre of Sydney, maybe other than units. But it does seem to me to be an interesting question. If you're an international investor and you're thinking about buying into Australia when the exchange rate is pretty low, one of the observations is it makes buying property in Australia a lot cheaper for a lot of international investors.
Yes. Well, and we have don't we have I can't remember, is a policy actually out there that it was just mentioned that Button might stop foreigners buying? Or was
for
it
2 years? 2 years. Yeah. As a possible policy. Yeah.
Is that a thought bubble still, or is it actually a policy?
I'm not sure it's come out as a full policy yet, but it was definitely floated in his recent speech.
Yeah. Look, I mean, I'm sort of, I think are on the same boat with this, Martin, in that, I'd like people in Australia to be able to afford properties and without sort of mortgaging the rest of their life.
Yes.
And that, having a reasonable place to live and lower costs is good. Whenever people talk to me about what should they be doing, I try and look at it from two perspectives. One, are you trying to do this for lifestyle reasons? Because if this is somewhere you're going to live or something like that, then don't ask me. You should be asking yourself and looking at your own budgets and working out what's reasonable, because it's not an investment decision in that. And if you're going to, especially if you're thinking about buying something and owning it for 10, 20 years, or hopefully longer, then the view over the next few months is not, or the next few years is not that important. If you're thinking about this as saying, property prices have been falling and maybe they'll bounce over the next 2 years and then I'll turn around and flip it. I think you need to run your numbers on the costs of actually getting in and getting out and things like that, because you're running some pretty big risks with those. It might work out well, but if you've got a short time frame, the amount of money you need to spend on stamp duty and anything like that gives you a 5 to 10% handbrake on whatever. You got to make 5% just to get your money back. before you start looking at other ones. And then you go, well, on a rental yield basis versus what can you expect elsewhere? Look, I think yields have obviously run up. Rental growth has been much stronger than we've seen at any time in the last 50, 60 years. And I think what we're seeing now is a limit to how much further rental growth can go. It has slowed, but I think that's a sign that just people can't afford it. We've been in a per capita recession for a number of years now. Wage growth hasn't been strong, and I think there will be areas obviously where rents will grow, but I think as a broad sense across Australia, expecting rents to grow much above inflation is going to be optimistic over the over the near term. I think you've had that sort of push through, and it's hard to get that next rise in rents. If we start seeing some pretty broad-based rate cuts, then maybe there's some arguments about property prices going up. But I think the rental year, the amount of money coming in rent is going to be tough to grow that anywhere near the rate we've seen for the last couple of years.
Absolutely. In fact, the net investment yields are getting more and more compressed at the moment because the growth in the rental is not catching up with the increasing costs, particularly for investment properties and insurance. All the other costs of repairs and those sorts of things. So I'll cover a bit of that on my show next week, actually, because I've just run the updated models for the end of January, and it's quite fascinating just watching the overall returns decaying for many property investors on a net investment yield basis.
And there's obviously, I'm sure you've dealt with it in the past, but especially if I'm assuming Central Sydney, you're talking about buying into an apartment, as you said, and the costs for some of the strata fees and they've been going up at quite reasonable rates, and they may or may not be connected to the actual costs.
Correct.
The cost of what's being run there, and I think there's plenty of cases where it's not as fair as what it might seem it should be in terms of how these costs are allocated and whose brother-in-law gets the job to fix these
and
things.
also, of course, some international investors seem to be able to avoid paying the strata fees, which means that effectively those who do pay often have to deal with arrears, which is another factor in the economics of how strata management works, as well as the unfair practices that we're seeing in some areas. It's a real minefield. And of course, the quality of construction is quite limited in some areas. So all of those things are in play. Well, we're coming up towards the end of the show, Damien. So as we come to it, last thoughts from you in terms of, it seems to me that my message to investors is don't panic, right? So there is a degree of uncertainty about the markets, but that's always true. Some of the volatility swings that we're seeing may present some opportunity to buy at lower prices. So you need to have a view as to what it is you would buy at what price, so that you don't just sit there in a sort of complete stupor when it happens. But also, as with all of these things, the level of uncertainty and volatility will probably continue. So that's also something to bear in mind.
Yep, and I think you need to sort of take a view on one direction or the other in terms of what you're expecting from Trump. I think it's pretty obvious he's going to try and push boundaries everywhere as much as possible. And so the answer is either he's going to push boundaries and he's going to break something, and that's going to be, he's going to push it too far, and there's going to be massive fallout from that. Or the second one is, as he starts to push things too far, the stock markets will react and he'll reverse on those ones and keep pushing on the other ones. And that's the view I've taken. I do think there's a lot of damage being done in terms of to the US institutions, and I do think there's particularly some of the corporate governance issues. But history has shown they take a long time to play out. That might be a 5-year, 10-year, experience before things start to explode. It's usually not. It's usually, the minute you pull these regulatory bodies isn't usually when it all falls apart. It's usually considerable time after. And so,
yes, and all the experience of last periods of volatility is the long-term impact is never seen until sometime later. Think of the global financial crisis, which was 2007. The peak consequences of the global financial crisis actually hit 5 years later. It was a long, slow grind. And I suspect some of these things that we're seeing at the moment will have profound consequences ahead. It's just very hard to pick where those will be. And I always worry when people see prices drop a little bit and then panic to sell, because quite often that is actually not a good time to sell.
Yeah. So in a broad sense of things, just in terms of big picture numbers, we're in the markets are expensive. They're in the sort of 90th to 95th percentile. But if you make the assumption that regulations, all these regulatory changes that are going away, and the tax cuts that are coming through, you can add 10 to 20% in terms of company earnings, pretty much straight onto the top of current forecasts. That'll bring you back to sort of the 75th percentile of where we've been in the past. And so it's expensive. It's like, it's above average in terms of expensive. But if you then go back and say, well, we're in a environment that's interest rates are going down, but we're not going into recession. We've got obesity rates in the US have stopped rising for the first time in forever. We've got AI, pushing this through. You can go through a number of different other factors, potentially self-driving cars and other stuff that's going on. There's some pretty meaningful productivity gains that are happening. And so in that type of environment, would you be happy to pay 25% above average? Yeah, sure. And so that's sort of one way to look at it. The other way to look at it is, Trump's around, he's pulling every lever he can. He's going to push things until things break, and markets are really expensive. And when things break, they've got a long way to fall. And there's, you need to be aware of both views. I think the second one is where we're pushing at the moment, but it's not without its risks, and you need to be aware that we're in volatile times. Yeah.
Well, as Madeline says, Trump transforming the US into Putin's Russia wasn't on her bingo card. Will Trump be impeached, as Cookie Boy says? Who knows? Well, what we do know is that by the time we chat again in a month's time, Damien, things will be different.
Yeah.
So,
yeah, well, and actually, but along that front, I was just one last thing then. The people who he's been pushing through the Senate and I guess the pushback from Republican politicians has been very, very little on these. And some of this is that he's put out such crazy candidates that then the really crazy ones, that the next crazy ones don't seem so bad. I would see, there's 2 years before you need to worry about any political consequences, I would think. And so, you need the midterms to come through and a pretty big swing around in that. So yeah, I think he's pretty safe for the next 2 years, just based on what he's managed to do so far and the amount of pushback he's had, which is incredibly small.
Absolutely. Well, thank you very much, Damien, for your time tonight. Really appreciate it. And as always, links and things are below for those who want to follow What the World and Nucleus Wealth, What the World Funds and Nucleus Wealth. So look forward to catching up with you again next month, and really appreciate your time this evening.
Thanks, Martin.
Take care. Bye-bye. There you go, folks. Hope you enjoyed that. Very insightful stuff from Damien, as always, and we'll look forward to having him back next month. Just to say that next week I will be on, and I'll be sharing the latest analysis and modelling, and I want to specifically look at some of the investment issues that we touched on briefly, because there's some very significant issues there which I think are worth exploring. Anyway, thank you very much indeed for spending some time with us this evening. I hope you found that useful and insightful. The dogs are still here. They'll need a walk now, so I'm about to take them out. And I'll look forward to seeing you next week for another live show, and, of course, the daily shows recorded. Meantime, this is Martin North from Digital Finance Analytics, signing off. Cheerio.